Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Sales International Limited, and here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar in New York. The core of the bullish support remains the lower time of the December 2020 to April 2021 bullish shift pitchfork, currently at 1763. We also have nearby the reassigned April 20 to date uptrend, currently at 1957, and the April 21 to date uptrend, currently at 1747. 3 weeks ago, the market tested down to this lower time and used it as a springboard to make the move higher that peaked early last week with a horn top variation on a double top. Since then, prices have moved lower, down through the flatlining long moving average, currently 1867, the medium moving average last Friday and today, currently 1834, and today the short medium moving average, currently 1826. So far, we've only had closes below the long moving average, but that may be changing as recently as today. Now, last time I did have a downtrend dating from the middle of May, which I used as the upper trend line in a sideways triangle pattern. This was breached, broken, looked like it might be a genuine break higher. However, the market peaked at the February 2021 high 1894 with a shallower downtrend from April just above. Thus, I've retired this broken downtrend, for which there seemed high hopes, and kept the April to date one still on the chart. This has also meant the retirement of targets X and X1 from my daily chart. These were the targets for the sideways triangle utilizing the May to date action that has since become redundant. So, what do we have left? Well, you could still look at this April to date downtrend as a possible new upper trend line for a sideways triangle, but it is not an elegant solution at the moment, though I would suggest keeping an eye on it. Alternatively, there is another idea I suggested last week, which may be a fit, though right now it doesn't look that great. It is to look at the August to September action as a possible double bottom. There is merit to this idea. This is not a great example of such a pattern, but it could give an initial target X2 in the 1963 area and a secondary harder reach target X3 in the 2005 area. There's also a newer idea, one that is also, I'm afraid, not that perfect. It is to look at the August to date action as a possible bull channel, currently 1741 to 1780. The main disadvantage of this one is that the recent horn top pierced the upper trend line, even closing over it twice before coming back in and off. I'm not sure how much permanent damage this may have caused, but the subsequent dip late last week after the move higher has seemingly started to slow down as prices have dropped down through the moving averages. Below we have the 21st century absolute Fibonacci line at 1809, which is a dubious support, and then seemingly little in way until the 50% Fibonacci line at 1768 of the March to November 2021 move. Yet there does seem to be quite a bit of recent congestion before the 50% Fibonacci line. This brings me to my final point, one that I highlighted last week and which I suspect may be why the market is still waiting, that is, if that is the right word, trying lower gently if that is the right word. This is a highly symbolic pattern in the making. You see, we are now set with a week and a bit to go of October to possibly have a monthly key reversal here in New York raw sugar. So, if we close on Monday the 31st, that's next Monday, either above 1842 or under 1789, then we're beyond. Anything in between and we'd have a lesser outside month pattern. Right now, well, we've moved from a monthly key reversal up to a lesser outside month pattern. I wonder if this will hold through to the end of this week. Europe white sugar, Ice Europe white sugar in London. Since mid-September, this market has been dominated by just a one pattern, the changeover gap. I'm going to say a lot of things about what happened beforehand, but the changeover gap here on a continuous daily chart is really big. The action stretches from roughly the September 2016 high at 619 even down to the 50% Fibonacci line of the July 21 to date action at 522.80. And a congestion seen in early 2017 at 517.80. The actual gap is from 541 to 603.60. There have been a number of attempts, initially tepid in September but more active in October to try and fill it. These recent attempts higher peaked out just over the February 2017 high at 565 even. And we saw prices come down quite hard last week, down through all the moving averages with a second close below the slowly rising long moving average, currently at 538.90 last Friday. Interestingly, last Friday's action was a bullish one with an outside day along with a bullish piercing line pattern, but that's not being followed through necessarily today. We now have 4 distinct bands of support below. That helped the market back in September as well as late July, April, May and mid-March. They consist of the 50% Fibonacci line of the July 21 to September 2022 move of 522.80, along with congestion at 517.80 and 514.5. This one dating from early 2017, and finally at 509.5. I suspect it's because of these congestions acting as supports that caused Friday's action and today's, well, initial somewhat indecision, but now looking as if it's going to be testing lower. One final thing to point out. We have the possibility of a dead cross, of the short medium moving average, currently at 552.80, down through the medium moving average, currently 552.5. This is not going to be a clean dead cross by any means, but that does not preclude it not happening. Just watch out for that happening in the next few days. Sugar white premium spread. Last week I spoke about how there were three salient points to recognize here, all big picture items. I want today to concentrate on the third that I spoke about. Is a bit dated but still relevant. It's how the upper time, currently at 225 3/4, of the recurring big old bullish Andrews Pitchfork from 2019 to 2021 managed to capture the top of the market, admittedly after it had been breached, but still capture it and turn it back down within a week into a weekly key reversal down, closing below the middle time, currently 151.5 of the very same bullish Andrews Pitchfork. This was and is still indicative to me of how this large bullish Andrews Pitchfork is still intact, if a little damaged, and how it has been mending itself. I spoke last week about three salient points to consider going forward as well. The first is that we have an ascending expanding wedge pattern, which I had highlighted in red trend lines, and is highlighted again, that has been formed since mid-April, currently 138.5 to 251.5. It was and is still not the best looking pattern I've ever seen of that type, but it is also still there, and it comes with all the possibilities such a pattern can invoke. Second is the monthly key reversal down we saw in September. Now, take this information with a huge pinch of salt, as the earlier monthly key reversal down we saw in July did not work out so well. So there's a big dose of question marks over this pattern, as well as to whether this has reignited a bearish incentive or not. The third point is one that is seemingly now no longer valid, but its breaking signifies a lot. The third point is also twofold. It is to consider the support being given to this market, or was being given to this market, by firstly the rising medium moving average, currently 143 even, and secondly by the support of 250% Fibonacci lines of the August 21 to September 22 move at 131.25, and the July 2019 to September 22 move at 128.75. These two 50% Fibonacci lines have been working in conjunction with the moving average in thwarting the market in some of its recent attempts lower until last week. Last week's weekly bearish engulfing pattern, if only just, was enough to breach and break below the lower trend line of the ascending expanding wedge pattern, and the two 50% Fibonacci lines as well, for close below all of them. This is only the first close below, so I would need at least another consecutive close below all three this week to be even considering placing targets below. But it's safe to say that there seems to be some good reasons to consider doing so. These are the finessed, if you like, the finessed salient points to consider going forward. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.